our very own brother who is willing.
Being recorded.
Okay. Who is willing to spend some time with us tonight and walk over some opportunities that he has found in this very country that we are all residing in. He's not selfish. He wants to share some of these ideas with us, show us the way to follow his footsteps, and also learn some other opportunities that we might not be aware of. And so I encourage you to listen very carefully, think of questions, and ask those questions. Fortunately, he says available after this talk, and he's willing to listen to us even on one-on-one basis. So that's good news. But that will not be a reason why you not listen tonight or hang up. And so I'm pleased to introduce to you Mr. Paul Amoah. He was born and raised in Ghana in the 60s. He completed the Kwame Nkrumah University of Science and Technology in Kumasi in 1986. He proceeded to join the Ghana Armed Forces in 1989, starting as a lieutenant. He served in various capacities in the Finance Regiment and performed different infantry roles and appointments both in Ghana and overseas before voluntarily retiring in 2003 as a major. Following a few years in the United Kingdom and Australia and some graduate studies in management and accounting in those countries, Mr. Amoah arrived in the United States and completed an MBA program at Idaho State University. He worked briefly at that university as a senior accountant before moving to Maryland in 2014. He launched his own business consultancy in 2015 and worked as such until he finally joined World International Group in October 2018. He's now a marketing director, a certified trainer, and an educator in personal finance and leadership development. He currently mentors 24 business partners and aims at helping them get to the next level in business and leadership. Mr. Amoah resides in Maryland, married with 3 adult children, and enjoys experimental cooking. Fresh after this talk, we are going to go through the most recent adventure in cooking. And also, you might be one of the new business partners that might be joining his team after this talk. And so, ladies and gentlemen, please join me as we welcome our guest speaker for tonight's virtual seminar, Mr. Paul Amoah. Mr. Amoah, please, the floor is yours. And we look forward to listening to the good stuff that you have for us. Thank you.
Thank you very much, Mr. Donatus. That was an amazing introduction. I really appreciate that. Yes, I'm an experimental cook, so I experiment with a whole lot of things, and you don't want to know the things that I've experimented with. It's only my stomach that can tell you. So on this note, let me share my screen, if you permit me. Okay, so just as Mr. Donatus introduced, yeah, we're just here to share some information that might be missing in some of our own build up towards wealth building and all those things. So some of the things that we've come across is what I'm going to share with you today. Some people might even have some knowledge about them. And I mean, that is okay. If you have some knowledge about them at the end of the presentation, you can let us know so that at least we'll be able to share ideas from your experience as well. So let me just. Okay, I'm trying to share the next slide. Okay. So just before I start, I mean, this is me, some historical pictures, me and President Obama and my wife in the White House, you know. So yeah, that was a very good day for me. And then on the far right is myself as a very young military officer in Lebanon. I think it was in 1992. And so that was when I was in Lebanon the first time. So these are just a few historical pictures. Now, the topic, as you can see, is in two parts. It talks about navigating overlooked financial strategies for your investment and retirement needs. So I would like to split them into two, investment side and then the retirement side. But we all know that some investment can also be used for retirement. And so sometimes there will be a blend of the two. So just indulge me a little bit. So on the retirement side, these are some of the retirement questions and concerns that a lot of people have. That is, how much should I save for retirement? Or what is the best way to save for retirement? How do I make my money last in retirement? Should I retire early? When should I take my Social Security benefits? Should I take my pension as an annuity or as a lump sum? How will medical expenses affect my retirement income? And then how should my money be invested once I retire? So let me also share some statistics with you. This is a little bit dated. It's from LIMRA. I picked it up from 2015. It says, when do people retire? Half of Americans retire between the ages of 61 and 65. So as we sit here listening to this talk, let us start thinking about when we want to retire. So if you look at the circles, you can see that 51% of Americans retire between the ages of 61 and 65. And then about 13% between age 55 and 60. And then 12% between age 66 and 69. Which group do we want to belong to? Or do we want to be in 50 to 54, you know, or less than 50? If you've planned well enough, I'm sure you can retire, I mean, much earlier. And there are people who retire very, very early, you know. Now, these are a few factors that affect your retirement age or when you decide to retire. So while the average American US retirement age is 63, when you decide to retire is dependent on tons of factors. And it talks about 4 different factors: savings, your lifestyle, your location, and your health. So the average, that is under savings, the average Social Security monthly retirement benefit is roughly 1,620. 1,620. So that is not enough. you know. So here it says that without a substantial nest egg, you may be unable to retire when you want, or you may not have enough money to cover your expenses if you're unable to continue working. That's why many lower their standard of living once they no longer bring home a regular paycheck. So the second factor is your lifestyle. Your desired lifestyle affects how much money you need to spend in retirement. For example, if you want to travel, you will need a larger retirement account balance than someone who is willing to downsize and stay local, And then your location. Now, if you live in an area with a high cost of living, like let's say California or some places in Florida, you need more money to retire, And also your health. Your health plays a very, very significant part in your ability to work. Now, if you have chronic or debilitating health issues, you may not be able to work as long as you like, causing you to have to retire sooner. Now, if you retire sooner, have you got some things saved, some funds saved that you may be able to use during your retirement? Now, there are several financial tools that people can use in their retirement. We have our local 401ks, our IRAs, Roth accounts. And then we also have the fixed index annuity or the annuities. So the annuities are like pensions, where they give you some guarantees. And so this is particularly the fixed index annuity. That fixed index annuity provides guarantees on your principal so that your principal will not lose as a result of any market fluctuation. And then it also provides you a significant rate of return. And then the most important thing is that it uses the index strategy, which locks in your gains. So whatever gain that you make in the account is locked in, so that you don't lose it anytime the market crashes. And then you can also have income for life. So you can create your own pension out of it, income for life. And then the bonus is that anytime you want to sign on with any of the companies, they give you a sign-on bonus. So if, let's say, your 401k is bleeding or is losing money, and you want to roll it over into any of the fixed index annuity products that about 7 or 8 companies that I know have, then they give you a sign-on bonus. So that can even help you to recoup whatever amount that you lost. Now, this is how I explain the index strategy. So the index is like the tracking of an index. Let's say S&P 500, Dow Jones, NASDAQ. The company will pick one index to track. So your money is not directly invested in the market, but it is tracking the performance. So if the market grows, or if the index grows to, let's say, about 7%, you are gaining all that growth. Anytime the market crashes and becomes negative, your gain is locked in. So you don't suffer any negative. Anytime the market turns positive, you grow again with the market. Until the market crashes again, they lock you there. And so we call it grow and protect strategy. But the official name is the index strategy. And so you don't lose as a result of any market crashes, but you gain moderately with the market, up to a certain cap. So there is a floor and there is a cap. And so you grow between the floor and then the cap. And that is the index strategy. And so there are 15 benefits that I want to share with you of the fixed index annuity. first of all, like I mentioned, it locks in the gain. It uses index strategy. Your principal is guaranteed. So whatever money that you roll into the account, you never lose it. Even your gains, anytime you make a gain, that gain is also not lost. And it grows tax deferred, which means that whilst it's growing, nobody is going to charge you with taxes. And then you can turn it into a pension, taking distributions from it or taking money from it monthly or annually. And there are sign-on bonuses. Yeah, there is a guaranteed minimum rate of return. For some of the companies, it's even 10%. And then we also have a 10% free withdrawal. For most of the products that I've seen, they give you access to the money and they give you 10% access. Let's say you sign a contract of about 10 years. So within the 10 years, your money is not locked up. You have at least 10% access, penalty free. But then, of course, because the money that you put into a fixed index annuity has not been taxed, anytime you take money from it, you have to pay your federal and then the state taxes. And then it's protected from probate. Now, anybody who understands the probate court system is very, very grateful that something like that can be protected from probate. Because if your estate goes into the probate court system, the minimum period that they use to make a decision is about 18 months. And so if your case goes into the probate court, don't expect any resolution now. And by the time you finish, the lawyers would have taken a whole chunk of your estate money, you know. And so, yeah, you can add your spouse. You can also have terminal illness as a rider. Now, if you want to be put in a nursing facility, yeah, there is a rider there. It also has death benefits, no management fees. That is the most important thing, no management fee, because you are not going to pay anybody to manage it. You have control over it. And that is key because management fee is around 2%. And so if you are not paying any management fee, that is really good. And then you also have the upside potential market growth. I mentioned that you grow up to a certain cap. So if the market is good, yes, you grow with it. If the market is bad, you are protected. And so it's a win-win. You don't suffer any negative as your colleagues who are in the market are suffering. No taxes, no penalties. Of course, you pay your federal and then your state taxes. But whilst it's growing, nobody is asking you for taxes. And then there are no penalties, unlike the 401k. If you withdraw money before you are 59 and a half years, you pay penalties. But this one, there are no penalties or fees to roll over your money. So you can roll over the money without paying taxes, and then it grows tax deferred. Now, at the end of the period, if you want to now take money, that is when you come in and then pay the taxes. And so these are some of the carriers that we have. American National, Delaware Life, Nationwide, Transamerica, Lincoln, Athene, Global. These are A+ or A-rated companies and a part of the American Fortune 500 companies that we have. So that is the fixed index annuity side for retirement, creating your own pension so that you have absolute control over it. Now let's come a little bit to the investment side, and I will still stray into the retirement side a bit as we go. So how do we avoid financial catastrophe in our lives? So the financial industry says that when you want to build a financial portfolio, you need to have a solid foundation, you know, like building a house, you must build it from the ground up. You have to build it right and you have to build it strong. Now, building it from the ground up means that you start with protection. But what do we see usually? Anytime we have extra money, all we do is that we jump into investment. We go and buy stocks, we go and buy cryptocurrencies, we go and buy other investments, ignoring protection altogether. Now, the danger here is that if something should happen to you, if any catastrophe, like God forbid, suffer a stroke. And so anytime you suffer a stroke, what happens is that the family's finances are severely impacted. Where is the protection? Meanwhile, if you had protection, that protection protects you from such illnesses like critical illness, chronic illness, and terminal illness. And also it protects your assets. So all your assets can be protected through that same protection. Your finances can be protected, your income can be protected. And so that is why the financial industry strongly advises and encourages people not to rush into investment. Start with protection as the foundation. When you have protected yourself, you have protected your assets, you have protected your family, then you can move ahead and then do whatever investment that we want to. When we buy phones, some of us even go ahead and then buy protection on the phones. And when we buy houses, we buy protection on the houses. You know, we buy insurance on the houses. But our own lives, it becomes an issue when we have to get some protection on it. But that is what the financial industry says. Now, these are key financial principles used by successful people. And I would say that they are by no means exhaustive, like these are all that there is to it. But let me just move my Zoom thing somewhere. Okay. So if you see point one or point number 1 and 2 are accredited to Warren Buffett. So Warren Buffett, the most popular quote of Warren Buffett is that rule number 1, never lose money. Rule number 2, never forget rule number 1. So he's emphasizing that if you are building wealth, if you are investing, make sure that you don't lose money. And so that is the number 1 key financial principle. Now, if you come to a management versus no management fees, are you paying management fees to a manager to manage your account for you? Now, if you do that, what happens is that whether you lose money or not, the fees will come out, you know? And so who do you want to satisfy? Do you want to satisfy the fund manager or you want to satisfy yourself? You know. Now, the 4th key principle is inflation. Inflation is one of the main financial killers when someone is building a portfolio. If you don't know and your rate of interest on any investment is below the inflation rate, by the time your investment lasts for 2-3 years, inflation would have eaten the value of that investment. And so inflation is categorized as one of the main financial killers when you are building a portfolio. Now, taxes is also a financial killer. Now, is your money going through double taxation? When you receive the money, you pay taxes. If you put it on investment and it grows, you pay capital gains taxes. When you take it out and you want to spend, pay sales taxes. Is your money going through several cycles of taxes? Now, flexibility. Now, can you have unrestricted access to your money? Unrestricted. Anytime you need it. Number 7, compound interest. Now, compound interest is a very interesting kind of concept. Albert Einstein is quoted as saying that it should be labeled the eighth wonder of the world. Now, are we using simple interest or compound interest in our investment? Number 8, social security. Do you know how much you're going to receive when you come to the stage at which you take your social security benefit? If you go to the Social Security Administration's website, it says that by 2035, the administration may not be able to pay the full value of a retiree's benefit. 2035, how long is it away? Would you retire that, or you retire around that time? So these are some of the things that people should consider and make sure that, they have it in check. Number 9, critical and chronic illness. Now, it says here that is the number 1 cause for bankruptcy. What is the impact of critical and chronic illness on a family's finances? Are we taking that into consideration? And then, of course, the estate and probate court system. That is what I mentioned earlier on, that the minimum time that they use to resolve a case is about 18 months. So are we going to wait for 18 months before our families get whatever we're leaving for them? I hope not. Now, the problem that we have in our community is that, do we have everything that we need in our portfolio? Is our portfolio diverse enough? Do we even know what to include in our financial portfolio? So these are some of the questions that we want to put to ourselves and then probably answer them. So let me share some common components of a financial portfolio. So some of the tools or financial tools that we use: checking accounts, savings, money market. Now, as I'm going through this, if there are any of these that you use, please note them down, because we will come to a time that we'll have to assess whether they are helping us or not, And so checking, savings, money market, certificates of deposit, 401k, TSP, 457 and 403B. Now, these are all siblings from the same parents, And then the IRAs, the Roth IRA, the Roth 401k, stocks, cryptocurrencies, annuities, life insurance, bonds, college savings plan, which is the 529 plans, social security benefits, and pension plans. Now, there might be some other financial tools that people are using, but these are the common ones that I needed to bring to our attention. Now, I mentioned simple versus compound interest, and I just wanted to demonstrate a little bit how profound compound interest is. Now, Albert Einstein, as I said, says that compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. So are we in the group that understands compound interest, or we are in the group that does not understand it, so we are paying it? So let's look at this example. And let's say somebody has 100,000 to invest at an interest rate of 10%. So in the first year, if you look at simple interest, that 100,000 is invested, 10% interest, the total becomes 110. It is the same with the compound interest in the first year. Now, the second year is slightly different. If you know simple interest, it is just the original amount, the principal that is invested. So again, 100,000 is invested, 10% interest. So the 10% for year 1 and 10% for year 2 are added together. So you have a total of 120. For compound interest, the entire 110 now becomes the principal. So it is rolled over into the second year and 10% is added to it. So it becomes 121. So you see that there's a slight difference. Now, as the years go by, let's look at year 5. The simple interest is 150,000. The compound interest is 161,000.
You know, because I'm desperate for, because I travel this night.
So let's look at year 40. Now, if you look at year 40, simple interest has increased from 100,000 to 500,000. But look at compound interest. Same amount of money, same amount of interest, but that is about 9 times the simple interest amount, $4.5 million. So that is why Albert Einstein says that those who know or those who understand it, they earn it. So if you are going in for any investment, if it's possible, check whether compound interest will be working for you in that investment. Now, if it's not, then maybe look elsewhere, because they are there. There are financial tools out there that can give you the compound interest, So the other thing that I want us to check is whether we are paying a manager to manage the funds for us, So some of the selected financial tools are on the left: checking account, savings, CD, 401k, IRA, Roth, stocks, annuities, life insurance, municipal bonds, and college savings plan. So those that you don't have to pay to invest the money are just a few. And so you have the checking account. You don't pay to put your money in your checking account. Neither do you pay to put anything in savings or CDs. But all these 401k, IRA, Roth, stocks, you have to pay in order to invest. Now, the indexed annuities and life insurance and municipal bonds, those ones too, you don't pay. Now, the life insurance here is not just the ordinary life insurance. I will explain into details. This is a permanent type of life insurance. So it's not just the term that most of us are used to. And so the next category that we will check is whether we are paying taxes. Remember, I said that taxes is also a financial killer if you want to build wealth, build any financial portfolio. So the same selected financial tools, but you realize that those ones that you don't pay taxes are not that many. You have the Roth, you have the life insurance, you have the municipal bonds, and then the college savings plans. So with the ones with the green check mark, you would have paid taxes ahead. You pay taxes before you put money into those accounts. And so you don't have anything to share with the IRS. Uncle Sam has no business in that account. So it grows, and then later on, you can take the money without paying taxes as well. Now, these are the major concerns that each one of us should be very, very conscious of as we strive to invest or build a retirement nest egg, So these are the categories: whether we are enjoying tax advantages, whether we are enjoying significant growth, whether we are not losing money, whether we receive protection or we have unrestricted access, which is liquidity, or whether we can leave a legacy from that same investment to our families, and then whether we can avoid probate courts. Remember, the minimum period is about 18 months. So you want to avoid it by all means. Now, these are the financial tools up there. Now, if you glance through, I think the one that gets closer to the permanent life insurance is the fixed index annuity with about 5 green check marks. So how many of us even know that there are some other financial tools that will give you significant advantages, very, very significant advantage. All we are being told is to put money in the bank, put money in your 401k, put money in your Roth, put money or buy municipal bonds, buy cryptocurrencies, you know. All we are thinking is growth, 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 growth. What about if we grow and then we lose a chunk of that growth? Would compound interest be working in that kind of investment? And so these are some of the things that we have to know. And remember Warren Buffett's famous rule. He says, never lose money. Rule number one, never lose money. So with this permanent life insurance, you will never lose money due to any market crashes because it uses the index strategy. It uses the index strategy just as the fixed index annuity. So there is no loss of money as a result of any market crashes. And that is very, very significant. Now, I think I explained the index strategy earlier on, so I will not go over it. But this is how it looks like. You grow up to a certain point when the market crashes, your gains are locked in, and then when the market turns positive, you grow again. You know, so that is how the index strategy works. And so let me explain the various types of life insurance that we have. And so we have first the group life. Now, if you work with a company that has life insurance as a benefit, it's usually a group life, you know, and so it's usually provided by your employer. And then we also have the term, whole life, and then the universal life. The last two are permanent, and the first two are temporary. And so term is just a shortcut of temporary, you know, and so these are temporary policies. And so if you look at group life insurance, the cost is insignificant or it's even free. It's provided as a benefit at your workplace for those who are full-time or part-time employees. Now, there are a little bit or a few disadvantages. Coverage ends when you leave your job. If you have a better job somewhere, guess what? That coverage ceases, you know, and it's only paid upon your death. It is only when you die that this policy, the group policy that is provided by your employer, that is when it pays. And it's no benefit to you, the client, whilst you are alive. If you are an employee, that policy has no benefit. If you are seriously sick, if you cannot go to work, if you cannot do anything, that policy is of no use to you. It only comes into force when you pass away whilst working at that job, you know. Now, if you are ill, if you are laid off, if you go on retirement, it results in the end of the coverage, you know. And very few of those policies actually pay out because most people, they change jobs very, very frequently. An average American changes jobs in their lifetime 5 times. So let's assess ourselves. How many jobs have you moved into? If you've done more than 5, then you are more than the average, you know. But if you haven't reached 5, then note that the average American changes jobs 5 times in their working lifetime. And it's traditionally not even considered life insurance. It's just an incentive for people to join a job, you know. And so they use it as a bait to encourage you to work with them. But of course, it has its purpose, and because it will pay your family upon your death. And then we have the term. A term is relatively cheap. It is very, very popular, you know. TV ads, banks have it, you know, it's bundled sometimes with auto insurance, all kinds of places. It's also sometimes offered at the job places. Now, the disadvantages are that they are temporary coverage. They are temporary, and so they come in 5-year lots, 5, 10, 15, 20, 25, and 30. So if you buy a contract, if you buy, let's say, 20-year term policy, the contract says that you have to die within the contract period. If it is 20, you have to die within 20 years before that money is paid to your family, you know. And so if you outlive the 20 years, guess what? That policy terminates. If you want to renew it, imagine it, you have grown 20 more years. So the premium sometimes goes up 6, 7 times. And that is why a lot of people abandon it after their first term expires. And because something that they were paying $50 a month now is about $800 and they cannot afford it. And so they just abandon the policy. So it has no cash accumulation because you are only paying for the death benefit and no benefit to the client whilst alive. Now, premiums increase when the term expires, like I said, and it's a gamble if you have to bet on your life. And because what happens is that you are betting on your life that you will die within the contract period. If you bought a 20-year term policy, what you are saying is that I'm going to die within 20 years. So if I die, give my family, let's say, $300,000 or $400,000. Now, do you want to bet against your life or you want to outlive that 20 years? Now, if you outlive the 20 years, and then you haven't done yourself any good service because you bet that you are going to die within the 20 years. Now, if you miss a few payments, that policy lapses. Now, most companies won't even offer a new coverage if you are 65 years and above, you know, and it's outdated. There are new forms of term life insurance that I've seen some of the companies offer, you know, new term policies that have much more value than these traditional old terms. And 98% of the policies do not pay out because people outlive the terms. If you live beyond the term and you see that the premium is skyrocketed, you just leave it, you know. And so we have the whole life, which is the permanent, which is the first permanent policy. Yeah, it covers you for your entire life as against the term policy. Yeah, as against the term policy that would cover you just for a temporary period. And so this one will cover you for the rest of your life or up to 100 years. And the premiums will remain the same. And the premiums, they don't change. And you can have cash accumulation in the policy. And the disadvantage is that it is the most expensive of the permanent policies, or people say it is the most expensive of the permanent policies. It pays only upon death, but some of the companies also have switched it a little bit, whereby you have some benefits that can be accessed even whilst you are alive. But it's not all the companies. Most of the companies don't have those benefits. And then if they don't have any such benefit, then it means it will not be very, very beneficial to you whilst you are alive, except that you can have access to the cash accumulation if you have anything there. Now, you can have access to the cash accumulation, and the cash accumulation does not necessarily belong to you, so you have to pay it back. You necessarily have to pay it back, you know. And so that is the nature of whole life. And the next one that I'll talk about is the Index Universal Life Insurance, which uses the index strategy that I talked about. There are people who are touting it as a family miracle. But for me, the number one benefit that I've seen is the peace of mind. And because it serves you whilst you are alive, and then also serves you even in your death, you know. And so it has so many different benefits. I don't want to list them all up here. I'll show a few of the benefits so that at least we can have an idea. Now, if you want to know more, yes, I can certainly sit with you and then show how you yourself, if you want one, is going to look like for you. Now, the disadvantages here is that you need to pass a health check. Now, anything that is very difficult to get into, it presupposes that it is good. I'm saying that it presupposes, it doesn't mean that all the time, but it presupposes that it is good. Now, another disadvantage is that 30%, that is the statistics as at the time I was putting the slides together, 30% of applicants don't qualify because a lot of people have health issues, you know, a lot of people have health issues, and some of the health issues are quite serious. So if you have some of these serious health issues, you may not qualify. And others say that it sounds too good to be true. And so for me, that is also a disadvantage. Now, let me show you a typical concept of the Index Universal Life. So this one, I picked it from a book. It was an insert in a book, so I just scanned it. And the title of the book is The Financial Pocket Knife. That is the title of the book. And if you know how a pocket knife looks like, and the Swiss Army knife, you see that it has all kinds of tools. Now, it is a pocket knife, but it can do much more than the usual or average pocket knife. So let's get into it. So you pay a premium. Now, the premium that you would have paid just for the term life insurance, in this case, you are paying something extra. So that portion that goes for the protection is for the death benefit. And then the extra is put into some kind of a savings or an investment. Now, I'm using quotes because the insurance industry does not want it to be labeled as an investment. And so here you see that the writer is labeling it as savings, you know. So a part of it is put into some savings for you. Now let's look at the protection side. So it gives you permanent life insurance. And like I said, it covers you for the rest of your life up to age 121. That is, if you will live that long, it will still cover you up to that age. So it covers you when you are dead, and then it covers you whilst you are still alive. So let's look at the death side. It gives you tax-free death benefits. All life insurance gives you, tax-free death benefits. So this is not a peculiar advantage. But the other is that it bypasses probate. So if you have any money in it, and let's say you pass away, ordinarily, if it was 401k, that 401k account is going to be frozen until people come and say that, hey, this person was owing me 2,000, this person was owing me 5,000. The court will settle all of these before the rest is released to your family. But because it is life insurance, the proceeds, the death benefit does not go through probate. It bypasses probate. So nobody can lay any claim to it. And then you also have multiple settlement options. So you can take the death benefit as a lump sum, or you can take it in bits, like in monthly lots, in quarterly lots, semi-annual, whichever way that you want to take the money, they can allow you to do that. And so let's look at the living benefit side. Critical illness. If you have critical illness, and let me list the critical, no, it will be listed on the next slide. So let's not go into that. So if you have critical illness, if you have chronic illness, if you need long-term care, or if you are declared by a doctor to be terminally ill, this policy gives you access, in some cases, up to about 90% of the death benefit. gives you that cash to use to take care of yourself. So you don't have to die. You certainly don't have to die. Whilst you are alive, you can still have access to the money and use it for your benefit. And so that is the protection side. Now let's look at the savings side. So the savings, it has some significant interest, it says it's based on a market index. You remember I said that the index strategy, it tracks the performance of an index. So it's based on a market index. And then there is also a downside market protection. So anytime the market crashes, you don't crash with the market. And so they protect you at a floor. That floor is guaranteed. It's guaranteed that you never sink below that. Now, the second benefit under the savings is liquidity. So you can have access to the cash that has accumulated in the policy through a withdrawal or through a loan. Now, if you want to take a withdrawal, you can only withdraw up to the amount of money that you've put in. And so there is no company that I've seen out there that will allow you to withdraw beyond your basis. So if you put in $100,000, you can only withdraw money up to $100,000. Now, if more than $100,000 has accumulated in the policy, then the best route to take extra money is to go through a loan. So with a loan comes some interest, favorable rates. Some of the companies that I've seen have a net of 0.25% net, 0.25% interest every year. So that is really, really insignificant. And then if you take the loan, unlike the whole life where you have to pay back any loan that you take, this one you don't have to pay back. You don't have to pay back because when you take that loan and you are not able to pay back and you pass away, that amount of money that you took as a loan can be now deducted from the death benefit and the rest given to you, your family. Meanwhile, you could have used that money to do some investment. And so it is a win-win for you, you know. And then the other thing is that it is tax advantaged, you know. So the contributions, the money that you put in, you have already paid taxes. You pay taxes ahead. So it is after tax contributions. And then whilst it is growing, it grows tax-free. That accumulation is tax-free. And then when it grows and you want to take money out, you take it out tax-free. These are some of the reasons why people say that, no, it sounds too good to be true. But is it real? It is real. The companies that offer term, the companies that offer group life, the companies that offer whole life are the same companies that are offering this index universal life. Why are people not told about this? Because initially it was labeled as the rich man's policy. It was labeled as the rich man's policy. So quite recently, about 10 years ago, some of the companies started now opening up to the middle income, and so that all of us can have access to these plans. Now, the last thing is that is creditor protected. If you owe anybody money, that person cannot access the account, and they can't take any money from you. Yeah, so let me speed up a little bit. And so these are the critical and the chronic illness riders. And so critical illness is heart attack, stroke, cancer, end-stage renal failure, you know, all these things. And then the chronic illness, if you're not able to perform any 2 of the 6 activities of daily living. So most people don't fail to plan. I always say that, you know, most people fail to plan. They don't plan to fail. Most people fail to plan. They don't plan to fail, you know. So if you have an idea, you should develop a plan and then you put it into action. So now you have heard something. I mentioned something a little bit about the retirement side. I mentioned a little bit about the investment side. Now, what's the plan? Let me suggest some plan of action for you. So there are three major events that can cause financial chaos in a family if there is no plan in place. Three major events. So the first one is sickness. How much income does it take to run your household monthly? Ask yourself that question. Do you have a permanent plan in place to replace that income in the event of sickness or illness? The American Heart Association says that every 30 seconds, 1 in 3 people suffer from cancer. Every 40 seconds, 1 in 4 stroke. Every 60 seconds, 1 in 5 heart attack. Are we exempt from that? Maybe not. Maybe not. So what is your IPS? What is your income protection strategy? What plan do you have in place to replace your income if any of these sicknesses, strike you down? So the solution is that you need a TLB. Now, TLB is a term with living benefits so that you can, term policies are very cheap. And so you can buy it cheap with a big coverage amount so that if any sickness should happen to you, then you can access the money, 90% of that death benefit that wouldn't have come to you until you die. So that is the first major event. Let me go to the second major event. The second major event is death. Now, currently, which one are you prepared to leave behind to your family in the event of the inevitable? Are you prepared to leave debt or are you prepared to leave a legacy? I hope we all are prepared to leave a legacy. What is your HEV? The HEV is your human economic value. The income that you would have brought to your family in your active working life from now on. If you are 40 years and you want to retire at age 65, your HEV is about 25 years times your annual income. And so if you are earning about 100,000 a year, then for 25 years, it's about 2.5 million. That is the economic value that your family is expecting for you to bring home. Now, if death happens early than the 25 years, what have you left with your family? And so there is a solution too, we can create an instant estate for you. And the instant estate is that if you died prematurely, you were not able to create the estate that your family can rely on. So we can now go ahead and create an estate for you so that you can use or your family can rely on it in case the inevitable happens. The third major event is retirement. I'm sure we have heard about the three-legged stool of retirement. Now, let me show you what they are. The three-legged stool has 3 legs. It's a stool with 3 legs. Social Security is the red one. Company pension is the black one. Personal savings is the green one. I mentioned that Social Security by 2035, the administration says that they may not be able to pay the entire amount. Now, company pensions, we know that it's almost out of reach for many new employees now. What type of account do you have for retirement? Is it these old ones? Are you relying on these for your retirement? Now, the solution is that whilst we are financing for everything, we finance our cars, we finance our houses, we finance our phones, we finance almost everything. Why can't we finance our retirement? Your retirement, you need to finance it so that you have a lump sum there and then you start paying it down gradually, and that is possible. That is what a lot of people are using. And that is what I'm trying to introduce or show you how to do. Now, can a funeral cause a family crisis? Yes. And so we are here to talk about ways to keep that from happening. I'm not any kind of expert in funerals or funeral planning, but this company, Everest, is one company that I found that can be relied on because they have a concierge service. Now, by concierge service, what I mean is that you, the family, don't have to do anything. They can come in and then organize the funeral. If somebody dies overseas, they can arrange and bring the body here to the US. If you die in the US and you want your body sent home, they can arrange to send the body home. And then when the body gets to the destination, the family can now take over. So it is all in a package. For some of the companies, this Everest concierge service is included in the life insurance plan. Now, for some states like Maryland, they don't have that kind of bundle. And so that is for us. What we should do is that anytime somebody passes away, who makes these decisions? Burial, cremation, how much to spend, type of funeral service, religious or secular, visitation, open or closed casket, all these decisions, who makes them? Is it the one who is grieving, the one who is bereaved? You know, in addition, you also get a will preparation package. So from this same concierge service, they give you the ability to prepare your own will and also an online vault where you can put your important and confidential information. You know, remember I said that most people fail to plan. They don't plan to fail. Let's be part of the group that plans out everything, including our funerals. Let's be that group. Thank you very much. It's been a journey. I think I went too far, and because I was supposed to finish at 10 and now it's 10:09. So please, pardon me. Now, if we have any questions, I don't know if Donatus, we have time for questions.
Yes. So, no, thank you. Thank you, Mr. Moore. This is very, very educative, and I'm sure we've all learned very important stuff from this. Now we have very limited time for questioning, but we are going to allow members to ask questions because we don't want this opportunity to pass by. And I see, of course, Sister Rose is showing an example. If you want to ask questions,
yes,
use the reaction button and raise up your hand, and I'll call you. And so the very first person I've seen is Sister Rose. Please.
Okay, thank you, Mr. Amma, for this very in-depth presentation. My question is, first of all, thanks for the information. It's a handful.
Yes.
I want to ask you, we are non-for-profit, right? We are a non-for-profit organization. Do you have a group insurance for the members? Because you're only talking about let me learn. You're only talking about individuals.
Mm-hmm.
So let's say I have an association and the group wants to have the index one that you actually illustrated. Can we, as a group, form a team to sign up for that group insurance? Because I heard you said you are in Maryland, right?
Yes, I'm in Maryland.
Because I know I've heard of Everest. So do you guys can do it for us in New York? Do you have the group insurance? And also, as a non-for-profit, how can we invest our money? Because I know we don't have that much money. How can we invest our money in the portfolio that you've listed so that we can get some money out of that, to get some interest out of the investment that we are making? So there are two questions: group insurance for the members, and also how to invest as a non-for-profit organization.
Yeah, and so let me attempt to answer the first one, group insurance. So I know over 100 companies that are on the platform that I belong to, and about 35 of them offer the group the index universal life strategy. And so I don't have specific information whether they are able to offer group. So far, I haven't seen them offer group. I've only seen them offer for individuals, because for the permanent life insurance, it is customized. Even with the whole life, it is customized. And so when they customize it like that, it depends on somebody's health. It depends on somebody's age. It depends on the state in which they live in. For term, the reason why they use term for group so much is that it is cheap. There is no cash accumulation in it. And so the insurance company is not at much risk, and the insurance company is not at much risk. But for the permanent ones, apart from the death benefit, there is also the cash accumulation. And so there is more at stake for the insurance companies. And that is why maybe I haven't seen them offer these index strategies for group settings. And so that will be my assignment. Yeah, I can go and then check, because we have a lot of companies and some of them could actually offer that. But I haven't seen it so far. So I will check on that.
Okay, so and also the age requirements, if you're checking it, check what the age requirements are. Is it up to 85 years or 80 90 years or something like that, so that if the group want to, sign under the non-for-profit's name, in other words, they will use the non-for-profit as a vehicle to be paying the insurance. The group will pay into the non-for-profit, and then they'll use that as a vehicle to pay. So if you can
I understand.
follow up on that and let me know.
Yeah, so I understand that. That concept, because they allow business owners to do that. They allow business owners to do that. For instance, the company will buy the policy, a permanent policy, on some of the key persons in that business, and the company will make the premium payments, on behalf of that key person, but the policy is actually owned by the company, And yeah, so there are some concepts out there like that. So I'll check whether they do the same for group insurance, for associations, for nonprofit, and all those things. And so, yeah, I'll be able to get back to you on that.
Okay, thank you.
Yeah, you're welcome.
And also the investment, the non-for-profit investments. How do we invest instead of putting our money in this the CD, the money market? You said the rates are very low. So yes, where can we invest to get a rate of return that's higher than what the CDs the CDs are offering?
Yeah, so for something like a non-profit, yeah, there are a whole lot of options out there, and there are a whole lot of options out there. But if you are looking for the life insurance based option, then the organization might be excluded because it is customized for individuals. It is customized for individuals. But the options out there that the organization can use is that municipal bonds. Municipal bonds are very, very lucrative now. Last week, I was listening to Bloomberg, and some of the cities actually have about 5%. Now, if you are getting 5% without much loss around this time, it is really, really, really good. And because these days the market is very, very volatile. So if you are getting about 5% and you don't have to pay taxes at the tail end, then it becomes something very, very valuable. And so, yes, I'll also look at some of these, investment options that are out there that nonprofits can use in order to gain some of the tax advantages that I mentioned to you in the presentation. Yeah, how does that sound?
Thank you.
All right.
Good.
Yeah, thank you. So we have about 13 minutes. At least we want to be done by 9:30 Central, 10:30 Eastern. So 13 more minutes. I know Didon, I know that's the name I saw. You raise up your hand. Can you please go ahead and ask your question?
Hey, Yeah, Mr. Amwa, I wanted to check, is that do you have any specific recommendation for like a family or individual retirement benefit or something that you recommend that will be of interest to an individual or a family?
Yes, I think I mentioned it earlier on. I mean, that was the first segment. I talked about retirement and I talked about a fixed index annuity. You know, so the fixed index annuity, you can have it in two ways. Now, it uses the index strategy, so there is a floor where you don't lose any of your principal or your gains. And then it grows moderately too. And so you have the growth potential, but then the protection on the floor. Now, there are two ways of funding this fixed index annuity. You can either roll over your 401k or 403b, that company provided retirement account that is going up and down. That if you check your retirement account, it is fluctuating like that. If you want to prevent that kind of fluctuation, you can roll it over into a fixed index annuity. And it won't have any tax implications for you until it grows. And at the end of that contract period, when you want to take out money, then you go ahead and pay the taxes as you would have done with a 401k. The other way to fund it is that you can fund it after tax. Money that you have already saved in your bank, which you've paid taxes on it, you can use it to fund that fixed index annuity. So you can decide that I'm paying every month some money into my retirement account. And that is your own retirement. You can have a pension-like kind of income out of it at the tail end of it. And so, yes, so that is how you can have your own retirement, have control over whatever you put in and what you get out. And so that is the fixed index annuity. Of course, there's also fixed annuity and then variable annuity. But those ones, variable annuity, it is invested in the market, so it goes up and down like that. But the fixed one has the protection of the floor.
All right, thank you, sir. Is there any way I could reach? How do I contact you? They're going to share your information with us so that if we want to reach you for one-on-one consultation.
Yeah, I think I have my number on the slide that is showing right now. I don't know if you can see the slide.
Yeah, otherwise, I mean, can you see it? Okay.
No.
Yeah, if someone can put it on the chat.
Yeah. I thought it's 208-242-7330. 208-242-7330. Okay. And we'll put that information also on our platform after this talk. Yeah, okay. So Mr. Moore, I don't see any other hand up.
Okay.
But I wanted to ask about the 30% who don't qualify.
Mm-hmm.
I know you also mentioned you have several insurance companies that you work with.
Yes.
I believe the requirements are not standard. Some may not qualify someone, but you can find another insurance company to insure the person. Now, I also know of some of the World Financial Group members who even go to the extent of following the solid financial foundation that you listed. So they want to be sure that you are protected, you're managing your debt very well, and have emergency fund before they even qualify you for that universal health life insurance policy. How does it work in your world? Are you able to get some members qualify for life insurance without going through even this, especially the financial foundation steps, just to make sure they don't keep withdrawing funds from their life insurance accumulations or cash accumulations?
Yeah, thank you, Donatus. Yeah, you are right. I mean, a lot of the financial professionals will make sure that you have all kinds of things in place so that when you start with your index universal life, you don't necessarily come and take money because it is a long-term plan. Remember, compound interest, the compound interest thing that I showed, it works over a longer time. And so if you are somebody who needs money urgently, it may be a problem. That is why some of the professionals will make sure that you have all those things set up. But certainly with over 100 companies, there are different standards. So we have an umbrella company which manages about 70 of the companies. And so usually if some of the main companies are not accepting a client, we just throw it to the umbrella company that, hey, can you search through all the companies that you have and see if any of them can accept this client for us? Because we want to cover every person that comes before us, you know? And so we try as much as possible. The only thing is that some of the clients don't have the patience, you know, to wait. If they are declined, then they are disappointed. If they won't take me and stop. But it is a process. And these people are the ones that are covering. I don't have any product. I don't have any service. I'm just connecting clients with the companies. And so I do my very best to make sure, especially if the person is an immigrant, every immigrant should have some protection. Every person. And so it is our crusade to make sure that every person receives something, and so that at least the family can also smile at the tail end of our lives. Yeah, so we are able to do that.
Yep, absolutely. All right. Thank you. Sister Lucky, please, your turn.
Yes, sir. Thank you, sir, for this elaborate information you have given. My question is in relation to Rule of 72 as far as all these insurance companies are concerned. How can you explain that, and which of the companies use Rule of 72 and beneficial to the individual? Thank you.
Yeah, so thank you, Lucky. The Rule of 72 is a financial concept. So it's a financial concept that actually was also accredited to Albert Einstein. Now, Albert Einstein says that if you are going for any investment, the way you can determine how soon your investment can double is to divide the rate of interest, or the number in the rate of interest. If, for instance, the interest that you are getting is about 5%, use 72 and divide it by 5. The result is the number of years it's going to take that investment you are going into to double. You know, now there are two sides to every coin. So if you are looking for an investment, 72 divided by 5, the result is the number of years your investment is going to take to double. Now, if you are going to look for credit from a bank, you know, and they are giving you, 10,000 credit card limit, you know, but the APR is 24%. Do Rule of 72 there. Divide 72 by 24, and you see that the result is 3. So every 3 years, the balance that you haven't paid on that card is doubling on you. The banks love Rule of 72. They call it the banker's rule. They love it to death. So anytime you're about hitting your credit limit, sometimes the banks will increase your credit limit because they want you to owe them. They want you to owe them so that the Rule of 72 can work against you. So anytime you are going for credit, you have to do a mental calculation of the Rule of 72, divide 72 by the interest or the number in the interest, and see how often that balance that you haven't paid is going to double on you. So that is how it can help somebody who is going for credit, somebody who is going for an investment.
Okay, thank you.
You're welcome, Lucky.
Perfect. Yeah, thank you. So we have 3 minutes to go.
Yeah, I got a quick one, Mr. Amwa.
Yes.
So,
Yes.
do you currently know any financial institutions that are doing rendering compound service interest on retirement?
Yes. So the strategy that I told Didon, the fixed index annuity, actually works on compound interest because you don't lose anything. So your principal plus the interest is now rolled over to become the next principal. Principal plus interest rolled over to become the next principal. So compound interest works in there. So there are companies that have, I think I showed about 8 or 9 companies, Delaware Life, Nationwide, Transamerica, Athene, Allianz, Global Atlantic. And these are all companies that have that fixed index annuity that offers that protection where you don't lose. And so your principal plus the interest becomes the next principal, you know. And so that is where the compound interest works.
Okay. Is there any way we could get that information maybe through an email or something? I will text you. I got your number. I will text you so that I can look at that more. Thank you.
Yeah, if you text me, yes, certainly we can do that.
Okay, Donatus.
Yes.
Donatus, there are 2 questions in the box. Time is fast. And I would advise that let's take notes of the speaker's information and do one-on-one consultation. So let me read the first 2 questions so that you give us a quick one. One of them says that what is the difference between Roth IRA and index? And the second one says that is it too late to sign up for a retirement plan if I want to retire in December 2023? Just take a few minutes and answer that one. The other questions, maybe we can defer them to one-on-one. If you need his information, let me know.
So let me take the last one first. Is it too late to sign up for a retirement? No, it's not too late. It depends on what you have already. If you have a 401k that has some accumulation, yes, we can roll it over into a fixed index annuity, and it can give you that kind of pension-like income. You know, so it's not too late. Now, the difference between the Roth and the index, the Roth, you pay taxes upfront before you put it, that money into the account, just like the index. Now, the difference is that the Roth is invested in the market. So every year that the market goes up, your Roth is going up. If the market crashes, your Roth is crashing. The only advantage of the Roth over the traditional, let's say, IRA or 401k is that you pay taxes before. So with the Roth, you're not going to pay taxes at the end. But the growth is affected by the market fluctuation. Whereas index, that money is not invested in the market. So compound interest is working in the index. And so that is the difference.
Right. Yeah, no, perfect. I think we've come to an end of this very interesting discussion. I wish we had about 2 hours to do this, but of course, he's open to meeting with you one-on-one to take it from there. And then we just want to say a big thank you to you, Mr. Amoah, for spending your evening with us. The information you provided is very helpful. We will continue to review it, and then I'm sure colleagues on this call will give you a call to see how you can help them with their financial planning. So, ladies and gentlemen, there are a few things I want to make sure that you take home with you, but the most important one is the key financial principles that he mentioned. And the very first 2 are make money, but don't lose money. And the second one is remember the first one, not to lose money. And how not to lose it is investing in the index whole life, universal life insurance.
The index strategy.
Very important. Yes, and your kids are not excluded. Even 2-year-old, 2-month-old, 5-year-old, they are not excluded. So please reach out to him and learn more about it and build that financial wealth for your family. To Mr. Moore, thank you very much for your time this evening. And to my colleagues on the call, thank you for spending time with us. I will now hand over to the president to take it from here. Thank you.
And thank you too very much. I'll say Medase Akpe. Thank you very much. Thank you.
Okay. Thank all of you for your participation, especially Mr. Amwa and Donatus for giving us this insightful information. And I also wanted to thank the members of Adana group. Like I said at the beginning of the presentation, the reason why we are here tonight. So one more time, want to thank you. Do not forget about this association. If you are on the call, you are not a member of Adana, that's Anglo-Ghana Development Association, North America, let me know or let one of the executives know. We formed this association in North America to take care of our brothers and sisters back at home. And one of the reasons, or one of the things we do is that we help our people back at home to alleviate them from hardship and distress. And as all of you are on the call right now, by now you might have heard it, or you are aware that there is a hardship going on in 9 districts in Volta region that have been affected with the Volta or Akosobo Dam spillage. That incident happened at no cost of our brothers and sisters back at home. You all see how they are suffering. Assuming, put yourself in any of them, their situation. Assuming you are in Ghana now and you are in that, you are affected by one of these things. What will you do? So currently what is going on is that there are some organizations who are accepting donations to go and help them. Some people lost their buildings, they lost their businesses, or included Anglo-Ghana district. Shima, Kuma area, they all are affected. All what we are hearing most is the North Tongue area, but our people in Anglo-Ghana district are also equally affected. So I'm appealing to all of you on the call, if you are not already donated. I know at Dana we are not doing anything as a group, but however, contribute towards whatever relief item Sienna is collecting, contribute towards whatever relief item OVG is collecting. They are all going to the same pot. Or if you can, there are some other donation locations back in Ghana. You can donate to any of them. If you need help to donate to any of those organizations, or you need help or need directions, do not hesitate to contact me, and I will show you, or I can direct you what you can do. Let's help our people back at home. They're currently in distress, and this is why we are here. We are fortunate to be here. So no contribution or no amount is too small. So I'm appealing to all of you to contribute towards a good effort to alleviate our people from the hardship they're currently doing. On this note, I wanted
Somebody is saying hello. Somebody wanted to talk.
Okay. Who wants to speak?
Somebody said hello earlier on.
Okay. Let the person text me, please. Text me, and I can let you. I'm about to close on this note. So please, on this note, I wanted to thank all of you. We do this seminar at least, not at least, twice a year. So watch out for our next advertisement. The topic may not necessarily be the same, but at your request, we may repeat it because the information is a lot for us. Once again, I thank all of you for coming. And on this note, the meeting is adjourned, or the seminar is over. Thank you. Bye-bye.
Bye.